people think retirement is one continuous phase. It's not. Retirement actually unfolds in 4 distinct phases, and if you treat each one the same, you can quietly steal away years of income, flexibility, and even peace of mind. I'm Dana Anspach, founder and CEO of Sensible Money. This video is a recording of our live webinar, Planning for the 4 Phases of Retirement. The framework I teach is based on decades of working with retirees and real data, seeing how plans play out over time. And be sure to stay to the end. Our live attendees ask fantastic questions, and we stay on to answer every one of them.
Nothing that you're seeing is a recommendation to buy or sell securities. Past performance is no guarantee of future results. And of course, we always recommend you consult your own advisors and do your own research before making investment or financial decisions. So with that out of the way, one of the unique things that we have been able to see here at Sensible Money is years and years of data. And the client that we've now worked with the longest, we have data going back to 2002, almost 30 years, or well, I guess not quite, 24 years. Let's not exaggerate. 24 years of data where we can see the planning and how we projected things. We can see how it came out in reality. We can see how the investments have matched to the goals of the person's plan. And we also see hundreds of clients go through these phases. And we've often talked about the 3 phases of retirement: the go-go phase, early retirement, the slow-go phase, where you just naturally slow down, and the no-go phase. But I've added the pre-go phase. I think of this as the 5 to 10 years before retirement. And I think it's really important that we think of these as distinct phases. I mean, there's kind of a smoothing as you run through them. There's not always a clear delineation between one phase and the next, but I can certainly say that your planning and investment needs change as you move throughout the phases. It is not one homogeneous plan that covers all 30 years of retirement. And so what I do in the book is each major section is one of these phases. There's a pre-go section. And in that pre-go section, I cover these 5 things: key mindset shifts, risks, spending changes, tax and planning opportunities, and how to invest. And then we move on to the go-go phase, and we cover these same things. And then the slow-go phase, and these same things, and then the no-go phase. And so that's what we're going to do in this presentation. We're going to look at these 5 sections, and we're going to apply them across each phase. So let's start with pre-go. Where does this begin? In the book, I tell my own story of retirement was something I planned for everyone else. And yes, I saved, and yes, I ran my financial plan, but I wasn't really connected to the idea. And I had this experience now almost 2 years ago in Beaver Creek, Colorado, where it was one of the first times I ever went on vacation and I wasn't bored. And it was a wake up for me to realize, oh my gosh, I finally have just the beginning of a vision of what retirement might look like for me one day. And so I think there's 2 sides to when the pre-go phase begins. There's the financial side, and then there's the, identity, the vision side, something that you connect to about it. And those don't always happen at the same time. Now, some clients we work with can't wait for retirement. Like the vision is already there. They are counting down. They have one of those apps they've downloaded on their phone, counting down to their last day of work. So they're ready. Now, sometimes people may be mentally ready, but they don't have the financial side in order. They haven't really run the numbers. And so that is your first step. If you have the vision, but you haven't sat down and done a thorough plan, you need both of those. But other people are like me, right? They have the financial side in order and, they do all of the things they're supposed to do, but they don't necessarily have the vision. And so we're going to talk about that because the key mindset shifts that you go through as you enter retirement or as you enter even the pre-go phase, or one, the identity shift. You need to understand that retirement is considered one of life's major stressors. It's right up there with getting married or divorced or having children. moving. These are all death in the family. These are all major shifts in our life. And retirement is one of those. And although there are some people who enter it without a qualm, that's not often the case. You have to know what you're retiring to, and that's not possible for everybody, right? Some people have the luxury of scaling down their work. We've worked with many people in the medical profession who can move down to 4 days a week or 3 days a week or 2 days a week or work something out with their employer to gradually phase into this. And that works really well. But other people don't have that option. Some people are so busy and their job is so encompassing, they don't really get to think about what they're retiring to until suddenly they have that space on their calendar. And so when we get to the go phase, we'll talk about, if that's you, what that experience can be like. If you do have the option to take a sabbatical or take an extended vacation and start to test the waters, it's a really good way to just begin thinking about what your new life may look like. What are you going to do with the time on your hands? Where are you going to find your social connections? The other aspect, of course, is the financial shift. And oftentimes the best savers make the worst spenders. And many of you are attending these types of webinars because you are good savers, right? You've worked hard and you've accumulated your acorns. And I can tell you, after decades of gathering, it's very hard to make that shift. I was in a client meeting earlier this week and asked this person who had long been a do-it-yourself investor, what was that catalyst that made you say now is the time to work with someone? And their answer was, I knew I wouldn't be able to spend what we could actually spend. I just knew it would be too stressful for me, and I needed someone else to run those numbers and really set up my retirement paycheck and give us permission to go enjoy these go-go years. And so it is a challenge. We see all the time that even people who have planned thoroughly, they get to that first few months of retirement and it just kind of that feeling of, oh my gosh, taking money out, it can be very scary. So you want to expect that. Some other shifts. As you're transitioning from pre-go to really thinking about that retirement date, you have to shift the way you measure success. Measuring volatility is not the way to do it. You want to prioritize what we call income certainty. So you want a plan that focuses on cash flow certainty. And that looks very different. And we'll be talking about that. And putting cash flow first, that's going to take precedence over maximizing returns. People are very return focused in the accumulation mode. And that makes sense, right? You want to maximize the growth of your nest egg. But when you get to the income side of things, measuring rate of return can actually be the wrong metric. And we'll use an example of what that looks like. Then in the pre-go phase, you have risks. And unexpected events, I would say, is one of the biggest risks. We often think of market downturns, and I have this over here on the emotional decision-making side, because market downturns, they are a risk, but it should be an expected risk, right? 1 out of every 4 years, the market's going to have negative returns. You can study history and you can see how that works out. And you can plan a portfolio to help hedge against that. It's not the market itself, it's your reaction to it that can compound that and really make it more challenging, make it a bad experience for you. But what often happens with market downturns are layoffs. They can often coincide. That can compound the problem. There's a big gap between when people think they will leave the workforce and when they do. Retirees often find themselves in a situation where they are retired 4 to 5 years earlier than they planned. There's the age 70 myth. I fear this may be me. I've often said I plan to work to 70, but roughly 33% of workers plan that, but only 6 to 9% actually wait that long. The reasons that earlier retirement happens, oftentimes it's negative factors. There's health problems, there's disability, there's changes at the company. Sometimes it's a family situation where one person needs to leave to help care for the other half. Planning ahead is an excellent defensive strategy. People who wait till the cusp of retirement, might be just fine if none of these unexpected things happen. But we've worked with many clients who planned ahead and these unexpected things did happen. And it was a much smoother transition to adjust and say, here's how we're going to change course to make this work. Now, on the market and the emotional side, I'm going to tell you a story that I tell in the book. It's about a real client, but all the names and details have been changed. So I call them Brett and Susan. I had began working with them in 2005 before the Great Recession and the big bear market happened. And I had shown them a set of graphs. And here is exactly what I walked through with them. I had this illustration. I got kind of obsessed with sequence risk around 2003, 4, 5, somewhere in there. And just realizing that the industry wasn't accurately accounting for the impact that this could have on someone in retirement. And so I would go back and I'd run these analysis. And here was 1973. And this was a balanced portfolio, 60% stocks, 40% bonds. The starting withdrawal rate was 5% or 5,000 per 100,000, and the withdrawal was increasing by 3% a year. So over 20 years, the withdrawal per 100,000 of initial principal was 134,352. Well, in those first 2 years, 73 and 74, the market was not good. And so you saw that portfolio balance drop. Imagine for every $100,000 you had, if you had $1 million, it would have gone down to 660,000. That would really be terrifying your second year of retirement. And that's what we often identify as market risk. But in reality, if they stuck with their plan, it worked out just fine. They were able to continue to take their inflation-adjusted withdrawals, the principal value covered, and eventually grew. And Brett and Susan experienced something similar to this in 2008, 2009. And I remember them saying, we're okay. We remember those graphs that you showed us. We're going to stick with our plan. And so simply understanding how markets work and what's happened in the past helped them stick with their plan. Now, there are also portfolio designs that we'll talk about in this presentation that can help reduce the impact of this kind of risk. But there's actually a bigger risk than this. 1973 was a long time ago. This is that same retiree retiring in the year 2000. Exact same scenario. $100,000 of principal, withdrawing initial withdrawal rate of 5,000, increasing at 3% a year. Now, in both these scenarios, we are applying 1% annual investment fees. Well, here, it was not a sudden downturn. It was just a slow downturn that never got the chance to recover. So yes, 2000, 2001, 2002 were negative years. They got 3 negative years right off the bat. But just when things really started to recover in 2007, then they encountered 2008, 2009. Yikes. And then again, things started to recover, but they just couldn't ever get back on track. Now, we had many clients that I worked with that retired right around 2005, 2007. And what's not reflected in this illustration is the fact that from 2009 to about 2020, we had almost no inflation. And so these inflation increases weren't needed, and we actually froze withdrawals, sometimes for a 4 to 5 year period. And if we illustrate that, that helps these numbers get back on track. And so there can be 2 different ways to mitigate these different types of market risks. In the previous slide, there's a portfolio strategy we'll talk about that can help mitigate your reaction and the actual, need to sell during market downturns. There's strategies that can help mitigate these short-term sudden risks. But when we talk about this long-term risk, well, there's a different strategy that helps mitigate that. And it's really having a dynamic plan. So you would know, when is it okay to increase your withdrawals with inflation? When do I need to freeze those withdrawals? And if things pass a certain threshold point, is there a chance I would actually need to reduce withdrawals? And so that is a planning strategy, not a market strategy. There are some market strategies that can help keep pace with inflation. That is making sure you have enough equities in your portfolio that you have the possibility of keeping up with inflation. Historically, that has been one of the best hedges that you can have to inflation. So then we move on from financial shifts that you'll go through to spending changes. And in the pre-go years, we often see people who are like, okay, I just bought my last car, or I got to do this big remodel before I actually retire, or we want to move and I don't think we'll be able to get a mortgage after retirement, and so we're going to do that now. But most of the time, those things aren't necessary. your financial life continues after retirement. People continue to get mortgages. There's just a different way of structuring those mortgages. Sometimes you have to set up defined distributions from retirement accounts to show up as income, even sometimes only for a few months. And that's what the underwriter needs to see for you to qualify. And there are still going to be auto purchases, and it's likely you will still do remodels to your home. And so again, with proper planning, you don't have to rush all of that in the last few years before retirement. But if you find yourself doing that, know that that's a pretty normal behavior. People want to rush and kind of prepare and cram it all in, and it just brings them peace of mind, and that's okay. The reality, though, is when companies like Mass Mutual study people's behaviors and attitudes before retirement and after retirement, they find that 75% of retirees feel less stressed a few years after retirement. And their anxiety about finances drops significantly after 5 years into retirement. And we see the same with our clients. The number of meetings they want to have and the details and the things they want to look at leading up to and even in the first few years of retirement are very different than someone who's already been retired 5 or 10 years. And they kind of like, oh yeah, I know this works now. I feel comfortable. What can really help alleviate some of the stress is building a cash flow plan. And if you have watched our How to Make a Retirement Income Plan video or webinar, it is on YouTube, you will see what that looks like in action. I also have an example in the Living Off Your Acorns book where I lay out what do we mean by mapping out income and expenses. Well, it's a lifelong plan of where your income and where your cash flow is going to come from, all the way down to what's your after-tax estimated monthly retirement paycheck. And we can chart that out so that people see that going up over time with inflation. And seeing that brings a lot of peace of mind for many people, kind of just, okay, I see that these are very conservative assumptions and I can see how this would work. And what it allows you to do is plan for things that are going to change over time. So your financial life is like a movie. It's not a photograph. It changes over time. And there are certain expenses if you still have children at home, right? That we've been able, in many cases, we'll have a line item for, expenses for the kids. And that tapers off as we expect the kids to, grow into hopefully fully functioning adults that are able to sustain themselves. Other times it's expenses you need to add in. It may be, wow, I'm going to have all this time on my hand. I would like to have a golf club membership, or I want to build in funds for extra travel. We haven't had time to do that. Or I want to build in funds for a big remodel because we haven't had time to do that while we were working. So creating this timeline allows you to account for some of these variable expenses. And it also, as I mentioned, allows you to see how your paycheck will actually arrive. The next thing to consider is tax and planning opportunities in the pre-go phase. And one of the things I realized after trying to rewrite my Control Your Retirement Destiny book many times over the years is every time I would start, there was always some kind of pending legislation. And I was like, darn it, if I write this, I'll publish it and they're going to put out this new rule and it's instantly going to be obsolete. And so I like to think of it as a framework, right? The rules are going to change over time. If there's anything that's been consistent, it's been that over the last 10 to 15 years. So this framework says you need to be able to spot the opportunities, the ones that apply to you. There's lots of things that we talk about on these webinars and on various articles that you can read, on all kinds of case studies. So we have a YouTube channel that Amy mentioned called Making Retirement Make Sense. And she and our other firm partner, CJ Miller, do some excellent case studies. But not all of those opportunities apply to you. You have to be able to identify how are my circumstances different than this person's, and does this make sense? Once you have identified the opportunities, there are certain planning levers that you can pull. When to retire, if you have that as an option. Some people are forced into retirement, but if you have the option to choose when, that's a planning lever. When to claim Social Security is a huge planning lever. How to time your income. Which buckets do you draw from and when do you begin drawing from them? Those are big planning levers, and when you pull them in the right order, you can often improve what the outcome looks like. You have to learn to play the odds. What I mean by that is I see so many people say, well, yeah, but, what if I pass away early? Well, you need to look at the statistics and really understand that people think life expectancy is, for example, around 75. Well, there's a measure of life expectancy from the time you're born, but that accounts for lots of people that may pass away due to accidents or illnesses at a young age. By the time you get to a certain age, those life expectancies have changed completely. By the time you're 65, your life expectancy isn't 75, it's closer to 85. And by the time you're 70, again, it gets extended. And so you really need to understand those odds. And if you're white collar and, you've been lucky enough to have an excellent career and be able to save, your access to healthcare also increases those odds. And particularly if you're married, you need to look at the odds over joint life expectancy. And when I think of odds, all kinds of decisions, whether I pay off the mortgage, when do I claim Social Security? Do I do a Roth conversion? Do I buy an annuity? All of these things we can plug into a financial planning model and create a metric that tells us, well, was this likely to improve your financial outcome or not? Now, if I have 20 decisions to make, let's just use that as a round number, as I'm entering retirement, and I make them randomly. And we do see people do this. Well, I just feel like this on this one. I feel like that on that one. Well, I may not be taking advantage of the odds. But if I have a system in place where I say, okay, for each decision, I'm going to use the odds to make that decision in my favor. Well, not every decision is going to work out, right? To be just exactly in your favor. But collectively, if I've had to make 10 or 20 decisions, they are going to work in your favor. So that's what I mean by play the odds. And then, of course, you have to monitor and adjust. We don't want any set it and forget it plans. Legislation changes, tax rules change, your situation changes. So there has to be a process to reassess your metrics. That's why I don't like the 4% rule. I don't find that it's very effective. We'll be talking about that. You have to adjust as you go along. Now, part of the tax and planning years for both the pre-go phase and the go-go phase, almost even into the beginning of slow go, which often starts in our mid-70s, there are so many opportunities. And this is just a quick snapshot of some of the age-related rules that you need to be aware of. At age 50, certain catch-up provisions apply to your ability to contribute a little bit more to 401k and IRAs. For public safety workers, it's also the first age they can access retirement funds without a penalty. There's certain ways you have to go about doing that for it to work, but it's good to know. At 55, your HSA catch-up contributions begin. And this is the age that any other workers, not public safety workers, can first access retirement funds like 401ks, not IRAs, but 401ks without a penalty, provided that the funds remain in the plan. You've got 59 and a half, of course, the first time you can withdraw from, for example, tax-deferred annuities, IRAs, retirement accounts with no penalty tax. Now, between age 60 and 63, we have additional catch-up provisions that apply. So you have to be aware of those. Age 60 is the first age widowers are able to collect Social Security. Doesn't mean they should, but it's the first age they could. Know that an earnings limit still applies in those situations. 62, earliest age you can claim Social Security. 63, this is the first year that your tax return will be used to determine what your Medicare premiums are 2 years later at 65. And this will determine whether IRMA, the income-related monthly adjustment amount, applies to you. However, there are 7 reasons that you can request a reconsideration to IRMA if it applies to you and you are now retired and your income is much lower. So you need to be aware of those. 65, that's when Medicare typically begins. 66 to 67 is full retirement age. The exact age plus a few months depends on your day, year, month, let's say month, day, and year of birth, actually. And then 70, maximum age, where you get the maximum Social Security benefit, no point in delaying past then. And then we have the RMD age, 73 or 75 if you were born 1960 or later. And this is when you have to begin withdrawing funds from a retirement plan, unless you're still working, and then there might be an exception. Oh, that's like a mouthful, right? That's a lot of stuff that changes throughout this particular phase that requires constant reconsiderations. Now, once you're past RMD age, things do begin to settle in. There's a different set of planning considerations in the slow go and no go phases that we'll be talking about when we get to those sections. Then we have how to invest. Many of you have heard me refer to the retirement red zone years. I read an article recently referring to it as the retirement risk zone. But we've often heard or read, if we study this kind of stuff, that sequence risk, that risk of a bad return as we're nearing retirement, is its highest in the 5 years before retirement up to the 5 years after retirement. And so in the book, like to think of this as, imagine this is your castle. You're building your castle as you're building up your nest egg. And at the top of your castle, or at the top of your nest egg here, sits your castle. And one of the strategies you can use to help reduce the impact of big negative returns right in this retirement red zone is to build a moat. I think of it as a moat. So what does that moat look like? Well, we like to refer to it as what we call the growth portfolio and then the paycheck replacement portfolio. So let's say you're sitting here about 10 years out from retirement. In this example on the screen, I used a portfolio that was now near retirement, and it was about a $1.65 million portfolio, but it wasn't that size when they started the planning, right? So they initially had a growth bucket, and let's assume 1, 2, 3, 4, 5, 6, 7. We're 8 years away from retirement and said, I'm 100% equity. I'm going to buy $60,000 of a bond or a CD that's now going to mature 8 years from now, the first year I retire. And next year, if the market's up, I'm going to do the same. And the next year, I'm going to do the same. Now, if you start this 10 years away from retirement, well, there might be 1 or 2 years where the market's not up. You would not exercise that change at that point, right? You would say, well, now's not a good time to move from growth to my paycheck replacement bucket because it's a down year in the market. So when you start far enough out, you can use those positive years to build out what we call your paycheck replacement portfolio. So now here you are on the cusp of retirement and you have 8 years of withdrawals and they're gradually going up because there's inflation built into them. And what that does, that's what I call your moat. Right? If you retire with this in place, it doesn't matter. A war starts, there's volatility. Relatively, we haven't seen a tremendous amount of volatility so far, but we could, right? Markets could be down 20%. We're not technically in bear market territory as I'm recording this, but that can happen anytime. Well, then you don't have to sell anything while it's down. And so the moat helps protect you from having to sell during a down time. It also helps behaviorally. So we find that people who know they have this moat in place just relax more as they enter retirement. They're less stressed. Yes, the growth part of their portfolio will still be subject to volatility, but they know their expenses are covered. It doesn't mean they're going to have to suddenly go back to work or reduce their retirement plans or alter their retirement date. So this, to me, is something you start planning for in the pre-go phase, whether that's learning about it, whether it's finding an advisor that deploys this strategy, but you start to look at situations or strategies, I should say, that can help you protect that retirement red zone where risk is at its highest. Now, one other thought on that. The research report that we just had read that refers to it as the retirement risk zone was, I believe, by David Blanchett and Wade Pfau. And they determined that it's the year before retirement that's the single biggest, riskiest year. That's not proper English, but you know what I mean. And so I thought that was interesting. We think of it as that whole window. I always thought of it as the year of retirement, right? The worst outcome would be the year after retirement, but they have said their research has identified it's actually the year before retirement. And so I think having this process in place can help tremendously. All right. So it's the pre-go phase. You've done your planning. You've thought about your identity shift. You've gotten your financial plan in order. You've mapped out your cash flow. You are starting to build your moat. Now, here you are on the cusp of retirement, about to enter your go-go phase. You're planning to travel. You think it's going to be so much fun. You can't wait to not be living by the alarm clock. If you're, in the corporate world, no more Zoom meetings and emails and instant messaging, right? Maybe you're just like, wow, I'm ready. Well, there are, again, some key shifts you have to be prepared for. The identity shift particularly can catch many people off guard. And we have a podcast episode that CJ, one of our firm partners, and myself did where we talked to Fritz Gilbert. He's the author of the blog post Retirement Manifesto, which I also guest blog for now. And he has just been brilliant at describing this particular phase. He recommends that you check out a TED Talk by Dr. Riley Moynes, who also talks about the 4 phases of retirement, different 4 phases than what I talk about. So Dr. Riley Moynes is really talking about, right at the cusp of retirement, the first year or two. Many people initially have this sense of elation, like it feels like vacation. You feel great. You're excited. But when that wears off, you can go through this time of loss and confusion. I had a client of mine that told me not until about 2 years later that she experienced this and that almost went through a depression. And I've since had several people share that. Yes, it was very, very difficult. I had a business owner in the office earlier this week who's now officially retired, but had tried to retire once at about 47, 48, and just found that he had run a company that had over 100 employees and just found that instant shift just didn't work for him. He needed to keep doing something. And so if you are in a situation where your job and your work situation doesn't entail you the space to gradually scale down or to have some trial and error and really explore this before retirement, then you need to be prepared that you could go through this after retirement. You may experience loss of confusion. You may need to go through a trial and error period while you figure out what's your new life going to look like. What are you going to do with your time? Watch for the 5 stages of grief. So that's what these are. You can go through denial. I retired too early. Anger. What am I going to do with myself now? Bargaining. Maybe I'll go back to work part-time or do some consulting. Depression. But what you're ultimately looking for is acceptance into this new phase. And really, I share these because I think just being aware that that's normal and it happens to a lot of people can help you give yourself some grace if you experience this. But there are also people, Fritz was one of them, who didn't experience this. Like he had been so deliberate about his new identity that he didn't go through this. But that is not everyone's experience. Then you're going to have the financial shift, which I talked about briefly. Hesitation to spend is one of the biggest behavioral challenges. I have had clients where I literally had to say, I am going to start sending you X amount of money every month, just so you see that this works. And it's just that kind of particularly people who grew up poor or in just less fortunate circumstances can really struggle with this the most. They may want to hold a lot more money in cash and just have that underlying fear that sometimes it can take a long time for that to fade away. So it's okay to feel that way. Having a plan in place, having guidance can definitely help. What happens to a lot of people who don't work through this is so many people just end up retiring, and at the end of retirement, they pass along more money than they had at the beginning of retirement. And that is a risk also, right? It's not the same as the risk of running out of money, but it's a risk of foregone opportunities, things you could have done that you always wanted to do, or things you wanted to do with your family, or charitable organizations you may have wanted to be involved with. So be very aware if you're feeling that strong hesitation to spend. You need a clear set of metrics. That's why I talk about spending metrics. That allow you to say, yes, the 4% rule, that is not a clear metric. It's not dynamic. It doesn't adjust for all the things that change every year. So you have to have some clear metrics. There's several that we like to use. One's called fundedness, which we talk about in our How to Make a Retirement Income Plan webinar. And there's another one we call a critical path, which we'll look at possibly a brief example of that here. So the other thing I think is you really need to measure success by life satisfaction. For some people, finance is their identity. And I would guess there's a few people listening who listen to all the webinars and all the podcasts that could be the case. And so, it can be really difficult to transition into that spending and relaxation if finance and watching your net worth grow up is your identity. So it's not about account balances or rates of return. You're really going to be measuring by life satisfaction. Some of the risks unique to the go-go years, overreacting, sticking with old measures of success. We've talked about that. Measuring still by watching the account balance on a day-to-day basis. Concentration and illiquidity. So you may have concentrated stock positions or illiquid private investments, real estate, that served you well in the accumulation phase, but those may not be the right structures that will serve you well in this new income phase. So the more you can look at getting out of these types of positions, making sure you're diversified, reducing concentrated risks, the better off you will be. And then, of course, unexpected health events. This could be for you or someone in your family. It could be an adult child, a grandchild that you need to bring back into the home. We've seen these situations over the years. They don't happen often, but they do happen. So there can be curveballs life throws at you. You also want to begin evaluating long-term care insurance or self-funding strategies and just understand, how you would cover some of those costs if you incur those later in life. But it's the beginning of the go-go phase, or hopefully even back in the pre-go phase is the time to at least consider that and begin thinking through it. Now, I've talked quite a bit about using old measures of success, and I want to give you an example of what I mean by that. Here's 3 investors. All 3 started with $100,000, and the market went down 20% in the first half of the year. So we measured halfway through the year, and everybody was down to $80,000. Well, investor A had no deposits or withdrawals for the year. Investor B had $10,000 they deposited right halfway through the year after this decline. And investor C was retired and needed to withdraw $10,000. And so, again, they withdrew that right after this decline. Well, the market recovered in the second half of the year. And so now we're up 20% and we've got 96,000. Amy, are you still there? I'm hearing somebody's sound. So anyway.
Hear me, Dana?
Yeah. Are you Annie?
I am not on mute, but I have no noise.
No noise. Interesting. I'm hearing something. I don't know where it's coming from. So
let me mute myself and I'll see if it helps.
All right. So here we've got end of year values that are all over the place, right? This investor A at the end of the year was down 4,000, investor B down 2, investor C down 6. Well, what were their rate of returns? I'll let you think about it for a second. Would you believe by the standard measure, what's called time-weighted rate of return, the rate of return was identical for all 3. And so when you see the S&P 500 returns, that's being reported as a time-weighted rate of return. What did the underlying investment do? Well, the underlying investment did the same thing, regardless of these deposits or withdrawals. And so the underlying investment had the rate of return that it had. It was actually at negative 4% in these 3 scenarios. Almost all performance reporting software reports in time-weighted rate of return. I don't like it. We don't do it. We use what's called internal rate of return, and there are many different ways to calculate that too. Because internal rate of return, you can clearly see that these investors had different outcomes, right? Completely different outcomes. And so, and my my numbers are off here, so I have to go see how this got copied over. I can clearly see that these numbers are a little bit off because, oh, no, they're not. Okay, I forgot about my deposits or withdrawals. See, even I can be subject to it. But time-weighted rate of return, internal rate of return, they're different measures, and focusing on rate of return can cause people to make bad decisions in retirement, particularly if they're looking at their portfolio and comparing it to something like the S&P 500. Their portfolio often isn't all in the S&P 500, nor is that what we would recommend because that's only 500 stocks. Usually there's bonds and far more diversification than that. And then they're saying, well, let's say they're like, well, how come I have a loss of 6,000 while the investment, really should only be down 2,000, or my neighbor only had this happen. Well, you all had different timing and you don't know exactly what formula is being used to produce that rate of return. And if you had cash deposits or withdrawals, it may not line up with your actual internal experience. So be aware of this. That's what I mean by using the wrong ruler. You have to have a different metric that says, okay, if I keep doing what I'm doing, will my plan work for life? Great. That's actually not connected to your rate of return on a quarterly or an annual basis. Next, you have spending changes. So spending changes in the go-go years are like a roller coaster. So JP Morgan looked at all of their banking data and found that many retirees see 20% changes in spending year over year. They call it spending volatility. And this is another reason why I'm not a fan of the 4% rule. Spending can increase dramatically one year. It can go down the next year. It is not a nice linear thing in retirement. It can be weddings that people are paying for, travel. Maybe they want to do something big with the family one year. It can be a remodel. It can be a health event. There may be another year where they feel like laying low and not spending as much. So it can be all over the place. And JP Morgan's data said that the spending volatility pretty much continues throughout retirement. It's not a nice and steady linear line like we picture it. And that means, again, you have to be able to account that it's not going to be the same amount that you need each and every year. You might have auto purchases one year, not another year. There's all kinds of things that come in lumpy forms throughout retirement. What you're trying to balance here is what I call spending drift, meaning how do you make sure there aren't too many big years that exceed your projections? So I use the example of, someone might come and say, we'd like to do this thing. It's going to cost $50,000. And most of the times we plug that in and we go, yes, it's fine. No problem. Versus we'd like to do this. It's going to cost $50,000 every year. And we plug that in and we go, oh, no. Like, that could get your plan in trouble. Well, you have to have a way to see that. And people who are sticking within, a very, scheduled 4% type of withdrawal structure might be terrified of doing that extra thing that costs $50,000 when in fact it might be perfectly fine for their plan and something that they should do during their go-go years because you're balancing this out with spending with intention. Now is the time. Home remodels, multi-generational travel, grandchildren's education. There's all kinds of things that you are going to want to do. If you've wanted to do them in your go-go years. The slow go years creep up on people. I think we're not expecting the changes that happen to us, the changes in our energy and our ability to go do some of those things. And we can learn, and it was one of the key motivations for me for the book is saying, if we understand what slow go and no go are going to look like, how does that change what we're going to do during our pre-go and our go-go phase? And I think understanding that is critical to the way we serve clients by really encouraging people to do things during their go-go years when we know their plan can fully support it. Then we get to tax and planning opportunities. In tax and planning, we're not going to cover all of these. It would be here for a whole extra hour. But there's so many things that happen in this window of time. When Social Security begins, that has a certain tax impact. We talked about Medicare premiums. What I really want to talk about are some key levers here. So most of the time in early retirement, which is what we consider go-go, some key levers are the ability to see when your income tax rate may be lower and either do Roth conversions, realize capital gains, or take withdrawals from retirement plans during those years rather than wait to require distributions. That is a key factor. Qualified charitable distributions begin at 70, so toward the tail end of the go-go years. If you are somebody that's charitably inclined, you can donate directly from your IRA, and it doesn't show up as income or as part of your adjusted gross income on your tax return. And then the timing of Social Security. Oh my goodness. Every time this topic comes up, people say, I don't want to wait. I'm going to take the money now. I don't want to put off spending. Well, we are not talking about putting off spending. It's a lever you can pull. Think of Social Security as a bucket, just like a Roth IRA or 401k account or a brokerage account. Well, as planners, our job is to say, well, if I pull from the buckets in this particular order, I can make the whole thing last longer. I can make it look better over time. And so we're not talking about delaying spending when we talk about delaying Social Security. We're talking about where you source the spending from. And I think if there was one thing I wish people could understand, it is that. And yes, we account for rates of return in the market and inflation and all of those factors when we do that analysis. And in most cases, it still makes sense for at least one person, if it's a couple, to delay to age 70. If it's a single, it often depends on life expectancy. All right. Income sequencing, again, we touched on that as a lever. Which accounts you tap first, what order you tap them in, another big factor. What I want to touch on in the go-go phase is something I don't see touched on as much, which is how are you going to pay taxes? So when we're working, most of us have taxes withheld from a W-2 wage unless we're self-employed, and then we're typically making quarterly tax payments. Well, there's something called the safe harbor rule that says if you pay in 100% of last year's tax, or if your adjusted gross income is over 150, you have to pay in 110% of last year's tax, and you pay it in evenly throughout the year, not all in the last quarter, then you won't owe a penalty even if this year's income is much higher. Well, in retirement, your income can be all over the place depending on where you source those cash flows from. And so you will either need to set up direct withholding. You can withhold directly from Social Security. We don't really like that because it can be difficult to change it. You can withhold direct from pensions. You can withhold directly from 401k or IRA distributions. And just like when you were working, when you do withholding, the funds get paid right into the IRS on your behalf. You get a 1099 at the end of the year, a report that shows how much you paid in. And when you do direct withholding, it's as if the funds were paid evenly throughout the year, which is a critical thing. For many people taking IRA distributions now, we like to pay all the taxes at once at year end from the IRA, so they got to earn interest on the money all year long, and we do it through direct withholding. So for the purposes of this safe harbor rule, it's treated as if it spread evenly throughout the year. But there can also be times where you need quarterly estimated payments. If you're doing Roth conversions, if you're realizing large capital gains from the sale of a property or from the sale of appreciated stock or mutual funds, then if that capital gain happens early in the year, for example, well, you need to, in some cases, pay in taxes to avoid an underpayment penalty, unless you're already meeting this safe harbor rule. Where we've seen people get in trouble is last year, their income, was really high. Well, I should not even going to give that example. Just know we've seen people get in trouble in these situations by not paying in enough, by not understanding this safe harbor rule. Then part of the go-go years is also having a paychecks plan. And what I mean by a paycheck plan is sometimes it's super simple. All your cash flow is going to come out of one account. In the households we work with, that is not the norm. We often see that we need to draw cash from multiple different sources. And this is an example of a real person. In the book, I call her Tanya. $3,200 of Social Security, $3,000 a month from a Roth IRA, $1,800 from her brokerage account, $660 a month from the IRA, and this is after taxes from the IRA, and I'll explain that in a minute, and $650 from the pension. So she has $9,310 a month of take-home income, but it's coming from many different sources. Now then, at the end of the year, she is going to owe taxes on some of this. So Social Security, if there's any capital gains from sales in the brokerage account, and on IRA distributions, and on the pension. So at the end of the year, we also calculate a lump sum tax payment that just comes directly out of the IRA that's in addition to this monthly take-home pay. Having all this laid out and seeing where it comes from is that part of the plan that I think helps people ease into their go-go years and have that peace of mind that, okay, I see where my paycheck is going to come from. You want it to feel as seamless as possible. I was working one day and I got paid on this schedule, and now I'm retired and I need to know these direct deposits are going to come into my checking account on this schedule. And that makes it a very seamless and less stressful process. Then we talked about setting up your growth and paycheck replacement portfolios. Well, I want to talk about one other aspect of investing. So here, there's different ways to build portfolios. And we don't talk about this enough as an industry. The standard way is people look at risk-adjusted return and say, well, how do I maximize return for a given level of risk? And risk is measured by volatility over a 1-year basis, sometimes quarter over quarter. Well, here, I just use this as an illustration. These are not reflective of actual portfolios. They're just educational samples. But I said, well, let's look, since July 2001 was where my starting point was based on the indexes that I looked at. And I said, well, which asset class maximized my return? Which one had the highest return in any 1 year? And that's this gray bar. It was actually international small cap that since 2001, it actually had a calendar year where it was up over 80%. But what was its downside? Well, it had another calendar year where it was down, nearly 50%. Well, which asset class had the highest 5-year average over that time frame? Well, it turns out that was also international small cap, not what most people would guess, but it had the highest 5-year average of any other asset class over 2001 through the end of 2025. And its downside wasn't too bad. It also had a 5-year period where it didn't make any money, right? That's this downside orange bar. And then which asset class had the highest return over the 10-year averages in that time period? And that was U.S. large cap. And its downside wasn't even negative. Its worst 10 years over that particular time period was about 3%. Now, if you've seen other graphs talking about the lost decade, you might see, that there was a decade where the S&P earned 0%. Why was this minimum 3%? It's just a slightly different index that I used. So I'm using something called Center for Research and Security Prices, CRSP indexes that look at large cap growth and value. It's a slightly different index than S&P, which is just going to give you slightly different results. Well, then I said, well, let's say I wanted to just know which asset class, had the least worst downside, right? So in a really bad year, which one was least bad? And so here, the one that lost the least in any single year over that time frame was, of all things, emerging markets. Again, not what I would have guessed, right? But it was still down about 40%. But that means every other asset class was down, had a year where it was down worse than that. And it just so happened that it also had, in other years, a really good upside, over 60%. If I looked at 5-year averages, well, which one was the least negative over 5 years? Well, that was also international small cap, same as over here. So these bars in this 5 years are going to be identical. And then if I looked at the asset class that had the least worst 10-year average, well, it was U.S. small cap value, right? So the worst 10-year period was still, pretty good, probably, close to, I think it was around 7 to 10% in here. And its best 10 years, of course, look better. Well, then you could just say, well, what happened if I just kept it safe, used 3-month treasury bills, which would basically be like leaving it in money market? Well, my difference between worst in orange and best in gray wasn't that great, but those orange bars, although they look positive, there was actually 5 and 10-year time periods where treasury bills earned almost zero over an entire 5 or 10-year time period. Or then I can look at globally diversified. So let's say I just diversified across all of the asset classes. In this case, it worked out to be about an 80% stock, 20% bond portfolio with 8 different equity asset classes. Well, again, this portfolio had its best year at over 40, its worst year, down just over 30. Its best 5 years, pretty good. Its worst 5 years, still negative. But its best 10 years, this is where I get excited. We now have a range that goes from about 4.5% to about 10.5%. And you can plan on this. So the whole process of building a portfolio is, how do I put assets together so even in the worst case, I still have a range of outcomes that's going to meet my goals? That's what building a portfolio is all about. And when you start to diversify, and particularly as you start to build portfolios that incorporate some asset classes that have held up better in the worst decade, you can build a portfolio that's very resilient. It's never going to be the one that's going to give you the highest return, right? You could go all in on a single asset class and say, well, I expect this one will have the highest return, but it's not going to be as resilient. And so we like resilient portfolios that are very diversified, where there's a range of outcomes that we feel, even in the worst case, you can still retire on that, right? That's what you need to know. And in the go-go phase, one of the key things you're doing is managing your moat. Now, this is a Scottish castle I found a photo of that I really liked because it was 3-sided. And one of the common questions I always get is, well, how long should my income ladder be? How big should my moat be? And it's really challenging to answer. I have a paper called the wind down paper, and I do these case studies where I look at it as a process of how you build your moat versus a set number of years that you want. There are people who feel strongly you only need a 3-year moat, which would be this 3-sided castle. And they say you have enough in safe investments to cover 3 years worth of spending, and that's all you'll ever need. Now, I don't like that. That makes me a little uncomfortable. I would prefer a longer moat. But the key is managing your moat. And what that looks like in the go-go phase is during up years, you have sold, or not sold, you have consumed some of the bonds and CDs and safe investments that matured. And if it's an up year in the market, you have sold some of your growth investments and then replaced that side of the moat that you consumed. And that's an ongoing process. During up years, you're selling some of your growth investments, you're replacing the part of the moat that you needed to use. And during the down years, you're just allowing your moat or your income ladder to get a little bit shorter. All right, now we're at the tail end of the go-go years. When does that happen? For most people, I see it somewhere in their 70s. Now, there's some where it begins in their early 70s, mild cognitive decline takes over, or some physical changes begin. There's some that it's not until their late 70s, and every once in a while, we don't see it really begin until someone's 80s. But most people slow down in their 70s, and understanding what that's going to look like and what that's going to feel like can change your behavior during the go-go and even during the pre-go years, of realizing that some of those things that if you've always wanted to do, you may not have the chance to do them if you wait too long.
Enjoying the webinar? Sensible Money hosts regular webinars covering all aspects of retirement planning, including live Q&A, where you can get your questions answered directly. To sign up, go to sensiblemoney.com or click the link below. We'd love to see you there.
Let's take a look at what slow go can look like. Let's look at some of the identity shifts and some of the financial changes that happen. Physical limits certainly creep in. Be prepared for changes. If you were a hiker, it might become walking. If you used to golf 18 holes, there might be a point where it turns into 9. Many people, if they're exercisers, turn to swimming because it's a low impact behavior. Health becomes critical. And understanding that and talking to people in this phase often changes people's behavior earlier, where during their go-go years, health becomes a big focus. I see a lot of people building home gyms right now, or spending money on gym memberships, or making exercise a daily priority during their go-go years so that they can extend their health span. There's a blogger, Dan, why can't I think of his last name? It starts with an H. And he talks about the human side of retirement. And he's talked a lot about health span versus lifespan. And while our lifespan may go to 85 or 90 if we're white collar, our health span may not. And so what can you do to extend your health span? That really becomes critical, and understanding what slow go looks like can help you focus on that earlier. From a financial standpoint, people are often far less stressed. They're relaxed. Their retirement plan has worked. Many discover they have more than expected, and we often see a shift toward generosity. It might be wanting to help family members. It might be organizations, whether it be religious or charitable organizations, where people will ask, hey, how much can I give away this year? Particularly, you're there to see the benefits of it. And that can be a meaningful experience versus knowing that somebody might inherit a significant amount one day when you're gone. So being able to help while you're there to see it is something we definitely encourage in this phase. And it often happens naturally as people just get out of that fear mentality and realize, okay, I'm never going to run out of money. Wow, I actually have more now than I did when I retired. And we see that a lot, even though we try to help people spend, we still see it. Then they suddenly realize I need to accelerate some gifting. And, it's a cool shift that happens. Some of the risks, cognitive decline, our brain changes. Matter of fact, by our 80s, our brains start shrinking. I did some research on this for the book, and it helped me understand that what happens is not only are we experiencing changes, the part of our brain that changes the first is the one that makes us aware that we're experiencing these changes. So, we may have had mom or dad or a family member, and we can get frustrated or exasperated, but they're not aware that these changes are happening. And that was like a light bulb that really went on for me, is understanding financial decision making is often one of the first items to shift. And research has shown yet, while our ability to make clear decisions is declining, it starts to decline at about age 60 and goes down a little bit pretty much every year thereafter. Our confidence in our abilities stays the same or increases. And so we are simply not aware that these changes are happening. This is one of the reasons why financial fraud is one of the fastest growing threats for people in these slow go and no go phases. Professional scammers build relationships. They can build them through accidental text messages, through social media. That's what's most common. They build a friendship. Somebody feels lonely, particularly if someone's lost a spouse or if they've been single throughout retirement. That desire for connection can be very strong, and these people are professionals. They know how to emotionally manipulate us. And so you need to educate yourself about how these scams work, build real social connections, not over social media with people you've never met, but you can focus on building real connections with real people that you see and can trust. Don't do co-investing with people. That's one of the most common things that happen is someone builds a relationship and then they're going to come visit. You've never met them face to face, but here I got this investment going on. You should invest with me. Here's what I'm making. No, you need to have some hard boundaries there and start learning about it now so that when you get to that age, you've essentially pre-programmed yourself that you just don't commingle funds. That's one of the biggest things you can do. You can also have technology tutors help people see that can help you. And our next webinar in May is going to be on financial fraud and some of the things you can do to protect yourself. But you can understand what a phishing email looks like, what things not to click on. You can learn not to respond to any text from strangers. You can learn not to click on certain ads or things on the web that can download malware to your computer, and then they can record your keystrokes. So you can set up two-factor on all your financial accounts. There's all kinds of things you can do to protect yourself, and you have to stay vigilant and keep up on that. There are also spending changes in the slow go years. And here we're seeing another graph from JP Morgan. This is their 2025 guide to retirement, where again, they studied real spending from credit and checking account and debit card transactions. And they found that as people moved from their 40s through their 90s, as you can see, spending declined. And we talk about that a lot. Even though we build inflation into the plan, we find that most people don't need their spending to increase at the same pace as inflation. And you'll see there's some categories growing here, like healthcare, and this is charity and gifts. And there's others that are shrinking. When we do a deeper dive on that, this is another graph from JP Morgan's Guide to Retirement. Housing costs. So this is looking at the first gray bar of someone in the 35 to 44 age range versus someone 75 plus. Housing costs about the same. Healthcare, we see a big difference. Food and beverage, typically lower. That reflects that slow go. People, sometimes due to hearing loss, they don't eat out as much. They're more comfortable being home. Transportation, again, not nearly as much traveling or out and about. But gifts and charity, as we said, during the slow go phase, those often increase. Tax and planning opportunities during this phase. Well, one of the things we see are Roth IRA distributions. They've had hopefully a decade or more of tax-free growth. And we've started to work with clients long enough now that when they want to start doing some gifting, we'll say, well, in your plan, we never have you tapping the Roth IRA. So if you want to do some advanced gifting, rather than letting this Roth IRA grow and pass along, maybe we do it out of the Roth where there's no tax consequences. Health savings account withdrawals, they are not a great asset to pass along to the next generation. So we advise having a plan to use those, consume the entire account between 75 and 85. Use them to cover your Medicare premiums. It can be a great use. Qualified charitable distributions, if you're, giving to charity, do it out of the IRA. Now that has to come out first before the RMD. Capital gains, watch for low basis positions. So, if you have ill health or you have a spouse who has some serious health conditions, depending on whether you live in a community property state or how you title your assets, there could be an opportunity for assets to get what's called a step up in cost basis at death. And so you have to be more careful during the slow go and no go years about selling assets that have appreciated a lot. You could be voiding a tax benefit there. Now, if you need the cash, you sell it, right? No matter what. But you just want to be careful about what you're selling and why. And of course, planning for care costs, right? By now, that should have been modeled into your long-term projection. For many clients, we use the home equity as a reserve asset to cover this cost one day. There are what are called hybrid annuity products. We talk about those in our annual Planning for Healthcare webinar, where we deep dive on this topic, that you can put money into that will provide a monthly amount, at least for a period of time. One of the strategies that I've like as people enter the slow go is starting to build up a little more liquid reserves. So we have one client who, slow go hit a little earlier in her late 60s. She moved in with her son. She has plenty of assets. He anticipates that they would be able to care for her for a period of time, but anytime she might need to move into some more advanced care facility. And so we keep $250,000 set aside in money market so that anytime that trigger needs to be pulled, we're ready and the cash is available. So preserving liquidity can be more important as you get to the slow go years. And then we have estate planning. So account titling and beneficiary designations are so often overlooked. They override your will. Even if you set up a trust, if you don't title things in your trust, assets can bypass the trust entirely. I've encountered this too many times. So know that how you title an account, if you title it jointly with an adult child, well, that account's going to go directly to that child. If you have another child, they may say, well, why did it happen that way? Now you can have a rift between the kids. Not always, but sometimes it happens. Be aware of challenges with durable power of attorney documents. So when a financial institution, when you present them with a durable power of attorney document, it might have been signed 5 years ago. A lot of times they reject it because it doesn't have the specific powers that need to be in there. And we have a podcast on this where we talk about how to plan for inheritances. And this is one of the things that we really look at is the specific powers that need to be there. And most financial institutions will make you sign their own durable power of attorney document. And if you are in a state where, cognitive challenges or health challenges have kicked in, that can be difficult. So this can be something you want to plan ahead for. Investigate the benefits of trusts. I tell the story in the book of Lucy and Pearl. Lucy's husband had passed away many years prior. She had one daughter, Pearl, and luckily, as we recognized that changes were happening with Lucy, we were able to consult with the attorney, add Pearl as a co-trustee so she could direct us to the decisions we had to make, the distributions to cover her care. So having someone that can be added as a co-trustee can work very effectively. Trusts are not necessarily about saving money in taxes. Matter of fact, they really don't save a revocable trust any money in income taxes. They're really about having control and continuity in these situations. And then determining who can serve as an executor, successor, trustee, power of attorney. In the book, I give a whole resource of what you can do if you're, for example, my husband and I have no kids. I was single most of my life. Who would I name? Even if I named one of my brothers and sisters, chances are they're going to be aging the same. Well, chances are they will be aging the same as I will. And so, what will I do? Well, I will find a professional fiduciary that is different than an investment fiduciary. And I give you some Google search terms to use: professional fiduciary or licensed fiduciary firm near me or in my county. And you're looking for a firm, not just an individual, so that there can be trained staff and a firm that's been around for a while. These are people that are often appointed by the court when someone doesn't have a guardian or a conservator. So there's firms that can serve in this capacity, and they can serve for you too as your executor or successor trustee if you don't have someone to serve in that capacity. And then later life planning, we have a podcast episode we're very excited that's going to release in a few weeks with a friend of mine, Denise Kay, who does consulting in the assisted living facilities. She helps place people, and she talks about really some of the things she sees and documenting with your family. It's not a legal document, but it's making sure they know what your wishes are. How much care would you want to have? Do you really want to be comfortable, or do you want life prolonging care? But we're not talking about the DNR, the living will type of document. We're really documenting your wishes in your later life. She says, most people have wills and trusts, but almost no one plans for what the last 4 or 5 years of their life will look like. And it's a challenging thing to plan for, but what happens is if you don't share your wishes and you have family, they're going to argue over what you might want. I have a client who's very clear. They're our oldest clients. They're 89, and they still have a house with stairs that they go up and down. They're amazing. And they said, you know what? When we get to that point, we've told our kids, you find us an assisted living home, you go out and live your life. We don't want you to be caring for us full time. Their kids will not argue over that now because they've made their wishes clear, right? Versus you can have one who's like, no, we should do this. And one who says, no, we should do that. So you need to outline your wishes. And I think that's critically important and something we don't think about enough. And how do you invest at this stage? Keep it simple. You want to consolidate. You don't want too many accounts. You want to reduce complexity. If you're still holding on to any illiquid investments, see if you can get out of them. Don't add new private investments. Don't add new business entities. Don't add things with surrender charges or things that are opaque. Keep it simple. Now, just like I do in the book, each section gets successively shorter from pre-go to go to slow go. And now we are at no-go, which is also our shortest section. One of the key things in the no-go phase, and I don't mean no-go to be, derogatory in any way. It just means we're not going out as much. Things have slowed down beyond slow go. One of the key things is accepting help. And it's something where people want to retain their independence. Of course we do. But accepting help is a key thing, a key mindset shift at this stage. It can start earlier with accepting help for someone to, come clean the house, or maybe someone who does home repairs or lawn care for you. If you haven't done that already and you want to remain in your home, accepting help and being willing to pay for these things is going to be critical. It can be finding trusted people to help, be copied on your statements or your bills. Who's going to pay bills for you when you aren't able to? These are important things to think about. Who can help you log in? Everything's moving to electronic, actually because it's safer, but now you need an app on your phone to do many things. Well, who can help you navigate all of this? You are going to need to come to the place of accepting help, choosing your people now, involving trusted family in financial meetings before they're needed, and documenting your preferences while your thinking is clear. Don't wait till your thinking is not clear. Risks, cognitive changes can alter personality. They can trigger out of character decisions. You can react emotionally in a way that maybe you wouldn't have before. And those are knee-jerk reactions really can come back into play here. Sometimes people suddenly change their estate. That can be a sign, again, of some cognitive changes. Health events can cause issues. I tell the story in the book of a case where, a client's parents needed care and they were so busy dealing with that. And while the mail was coming in for the parents, it stacked up, and a life insurance policy that they had had for over 30 years, the payment got missed and that policy expired. That parent ended up passing away. It was a $50,000 policy and there was just no way to reinstate it. So when those things happen, who is the person who's going through the mail? I think you should automate everything possible. I love automated bill pay. Make sure there's an automated process where your main checking account, this is what we do for our clients. There's direct deposits that refill that account. And then if you have your automated bill pays coming out of those, especially for key things like life insurance policies and long-term care, then you don't have to worry about that. It's not going to get missed. So make sure you put these processes in place that these accidental things won't happen. And again, document your intentions. Consider an independent corporate trustee if there are family reasons why you think a family member shouldn't be responsible for that. There are, again, licensed fiduciaries and independent corporate trustees that can serve in that fashion. Yes, they cost money, but they can be worth it in many cases. And one story I want to tell along these lines is a story I call her Maddie in the book, and she had a son we call Eddie and a grandchild, Hillary. And, Maddie left everything in her estate to a trust, and a portion of the trust was to go to Eddie, the bulk of the trust, and a portion directly to Hillary. But Eddie was the trustee. And so when Maddie passed away, Eddie looked at that and thought, I don't want to give all that money to Hillary up front. Even though the bulk of the estate was coming to Eddie, Eddie had enough. It wasn't about that. It was just about, he felt like Hillary wasn't quite ready to receive that large sum. Now, maybe she was, maybe she wasn't, right? He was doing it for her own good. But the reality is it didn't go directly to Hillary according to Maddie's intentions. And so this was a case where, things were perhaps done for the right reason. Hillary wouldn't have known her rights, that she could have requested a copy of the trust and understood that. But those things can happen. And so if you really want your wishes delivered as you intend them, that's where a corporate trustee can remove some of those conflicts or real life emotional situations that happen. During the no-go years, spending volatility can return. Again, on care needs, you may need to make modifications to your home. So that can be something to spend on. We talked about getting more help around the house. It could be meal prep. It could be someone to cook. It could be meal delivery for you. Of course, assisted living or memory care, if that is the need, can be more expensive. And that's often, again, where we have a plan to sell the house at that point and have that be a reserve asset. The silver lining, most of the time you'll find that, and we saw that graph where spending declines, is that these types of spending often replace other things. So there isn't the travel and the remodeling and the shopping and things like that. And so it's not as large of an additional expense as you may always think. Tax and planning opportunities in the no-go years. I touched on this in Slow-Go. Tax-free gains for the next generation. So when you pass, assets like a home or, a stock or a mutual fund that's not in a retirement account get what's called a step up in basis. So if you bought the home for $200,000 and you pass and it's worth $500,000, well, if you put a child on the title with you, they may now have to pay taxes on that $300,000 of gain, versus if it's what's called a transfer on death designation, it passes to them after your death, they don't jointly own it while you're alive. Then they get a reset. Their cost basis is $500,000, and that was the market value when you passed. And this applies to stocks and mutual funds too. And so selling the wrong asset, or adding someone to the title can eliminate, or you can lose some of these tax benefits. You need to be aware of that. We've actually had cases where, I had a client who, had a life, ending illness. The family knew what the timeline was, involved an adult child who became the successor trustee. And rather than sell the primary home, which they needed the funds to cover her care, they used what's called a pledged asset line, or rather than sell the brokerage account, you could use either what's called a pledged asset line, borrowing against the investments, or a home equity line of credit. And we actually calculated out, it ended up saving almost $200,000 versus if they would have actually sold that asset and had to pay the taxes. And so it was a really smart strategy to borrow at that particular phase, even factoring in the cost of the interest, because and so there are just some strategies that, from a financial standpoint can be considered. And then an elder care attorney can also be engaged in the slow-go or no-go phases, particularly if you have limited resources. If you have one spouse that's going to need significant care and another spouse that's healthy, you'll want to consult an elder care attorney to understand your state rules and see what can be done to protect assets for the healthy spouse. Our last thing in our no-go phase, how to invest. I kept it simple. No new investments, right? So this is not the time where you want to change things. We've had many clients come in who are helping a 85 or 90-year-old parent. And I had one in particular, I remember, and all the money was in cash. And I was like, look, you can go in and put this in money market. But, do I think at this stage you would want to transfer all these accounts and do this? No, she won't understand. Let's just keep it simple. Don't do anything new. It will work itself out. And so unless there's something really inappropriate for that person that needs to change, most of the time, I don't think it makes sense to make a lot of big changes. So if you're in a situation where you're helping a parent, oftentimes we'll help our clients evaluate what's in the accounts and, explain it to them and explain the impact from afar, but we'll say it might not be the time to make any big changes right now. All right. That went longer than I expected. I didn't realize how much there is, and that's such an abbreviated version of all that encompasses our 4 phases of retirement. My true hope is that as you see how these phases evolve, that you can learn and understand how you might make decisions differently in those pre-go and go-go phases just by knowing what slow-go and no-go looks like. And so with that, I think we're going to open it up to Q&A. I think some questions have come in while we were talking. And Amy, I think you're back on.
I am back here. I think it was me making noise. I realized I was adjusting my headset earlier and I was not on mute. So sorry.
No,
we did get a few questions. So I think you could see them too, Dana. Nothing super specific to this material, but, one of the questions early on was like, what if you have a pension? And so, I responded that can really help be a stable source of income in retirement. Also, I didn't say this when I responded, but, consider yourself lucky. We see less and less of them. But when we do see them, it really does, generally have a positive impact on someone's retirement plan.
It does. Yeah. And, the key things with pensions are your beneficiary designations. And when you elect that pension option, whether you're electing it for single life, for, joint and survivor if you're married, or sometimes, you can add a term certain payout if you're single and add an adult child on as the beneficiary. So it's really understanding the implications of the survivor benefit options that you choose there.
Yeah. We did have several people ask about recordings. And yes, we will be sending out a full recording of the entire webinar for anybody who's registered. So just keep an eye out for that.
Yes, it always goes on YouTube. And so then we send out a link to watch all our webinars or on YouTube, either on our Sensible Money YouTube channel, or now you're going to find a ton of stuff on our Making Retirement Make Sense channel.
Yep. Somebody else asked a question about changes to contribution limits. So I'm assuming they're talking about the pre-go years, but their question was about, do I have to contribute to pre-tax or Roth with the new rules? And so I don't know if you wanted to clarify that, Dana, or I can.
Yeah, go ahead. I mean, I'll see if I remember, because it changes the rules so many times. Sometimes when I don't have my cheat sheet in front of me, I'm like, but I believe now if you are what's considered a high income earner, I think the limit's about 150,000 this year, then any catch up portion in a 401k goes directly to the Roth. Is that correct, Amy? Yeah,
that is correct. Yes. So if it's your regular contributions, not the catch up, you can choose Roth or traditional. But if it's catch up and you're a high income earner, it has to be Roth.
And that high income earner limit will be indexed to inflation. And so it might be 150 this year, but my guess is it's going to change over time, just like all of the other features that are indexed.
Yeah. Let's see. Someone recently just asked a question about a suggestion on HSAs. Can I deduct money from HSA to reimburse myself for the automated monthly Medicare payments?
Yes. So you cannot pay for health insurance premiums from your HSA. So let's say you have a Medicare supplement policy, your HSA cannot cover that, but your Part B and D premiums, you can reimburse yourself. A lot of times we'll see people do that once a year at the end of the year.
Yep. Great. So here's a question. Any suggestions on how much money to earmark and set aside for each spouse for persons who are self-insuring for long-term care?
It's, the stats are interesting. So they would say about 250,000. So there's a graph we use in our Planning for Healthcare webinar where it looks at about 15% of people. So there's about 50% of people that will incur no long-term care costs, or I should say moderate costs, maybe help around the home, cleaning, someone to help with landscaping, things like that. And then on the other tail end of the graph, there's about 15% of people who will incur maximum costs. And typically that's running around 250,000 as a lump sum. But this is where, it's not necessarily 250,000 in addition, right? It's because there's a lot of other things you aren't spending money on at that time. And so that's where it becomes a bit more of a personal calculation to say, okay, we will run it out and we'll say, well, today it's $300 a day. We inflate that at 5%. What might that look like at your age 80? What are the living expenses, for a healthy spouse, or what living expenses would you not have anymore? So we have a different way of looking at it. But in terms of a straight lump sum, they estimate about 250. I think those are the most extreme cases.
Thank you. This is a really good question, too. I think there's probably a lot of confusion around this. Someone asked, can you please explain why QCDs must precede RMDs?
Yeah, it's just so the IRS basically says your QCD comes out first, and then you have your remaining RMD, and that way your QCD is part of your RMD. If it doesn't come out first, I don't really know. Like if you still didn't take out more than the RMD, actually, I don't know, but I know that's the way it is, but I don't know why. Do you, Amy?
I don't know the technically why. I did look it up when you mentioned it, because when you said that, I thought, I don't know if I know the details there. But I think it's just honestly one of the just another thing to make things more complicated than they need to be. I think there's rules around the first out. So the first money out is considered the QCD money, but I don't know why that is the rule.
Yeah, I don't know. Or, if it's just something, that way people don't. So if you took your full RMD earlier in the year and then did a QCD later, you would have actually taken out more from the IRA than you needed to. So usually we want QCDs to just be part of that RMD. And in order to do that correctly, most of the time the QCD comes out first, and then you're just left with, here's my remaining RMD balance. So administratively, it certainly makes it easier to track. But I believe it actually needs to go that way too.
Yep. So let's see. This question says, when you have a high value IRA post age 65, what Roth conversion method to use?
Well, I don't know necessarily what you mean by method. So if this was your question and you want to clarify, so we think of Roth conversions as, we're converting oftentimes up to a certain tax rate, and that simply depends on what someone's tax rate might be later. For some people, it might only be 12%. For some people, it might be 22%. But I don't know necessarily what you mean by method. Sometimes we're converting a little bit each year. Rarely are we converting a big lump sum all in one year.
The clarification was filing tax rates. So now I can try to take a stab at that. It is personalized. That the method is really mapping out what your current rates are and what we expect your future tax rates to be, and then trying to decide what rate to fill out based on your tax plan.
Yep.
Another question that came in was, when we publish the recording, does that include the Q&A?
Yeah, so it does. So when we put these out on YouTube, yes, it does include the Q&A.
Okay. Another question is, what is best to do in go-go years with money in a money market account, CDs, etc.? I have $300,000 for spending an emergency for more than 2 years.
It's a great question, right? Do you really need an emergency fund anymore in early retirement, right? Suddenly you can access all your retirement accounts if you're 59 and a half or older. And so I think it's a really good question. We often have, and it depends on how you're using that bucket, right? If that's part of what I call your moat, you're actually going to be drawing that down for your first year of retirement. You might say, well, I have a minimum level of 100,000. I will use this for my living expenses, and I will replenish it from other growth assets, when the other assets are doing well. And if it gets below a minimum $100,000 threshold, maybe that's your bottom line. So there's just different strategies. My thought is you don't necessarily need a quote emergency fund as much, but every household has different cash needs. Some people have higher net worths and they want to know they could go, drop $110,000 on a car if they found one tomorrow. Other households might think that sounds exorbitant, right? And so it's really difficult to give any kind of one size fits all guidance there. Without knowing your whole income and household situation.
This is a really good question. Do you have any resources to recommend how to find and how to evaluate and select a private fiduciary, or do you have a recommended list to share?
We don't have a recommended list because it's going to vary like all over the United States, right? You need to find someone in your local area. I do have a list in my upcoming book. And so it just offers some guidance on some key search terms that you can use. My recent post on the Retirement Manifesto blog, I really talked about estate planning, and there's some great reader comments. One of the readers uses this type of service, and they go online and have a review process every year where they look at online reviews for these services. And they ended up finding a new corporate fiduciary because the reviews for the one that they had originally selected got really poor, and they just weren't responsive. So they, will call and just have a conversation with them once or twice, it's not once or twice a year, every other year or so, just to check in and then check the online reviews. But really, it's a matter of searching, and the guidance that I give is in my new upcoming book.
Here's a question. So someone says between, their pension and their spouse's Social Security, by the time they get to RMDs, their taxes are going to eat up the whole pension. When they run software on Roth conversions, it doesn't show any substantial lessening of lifetime taxes. Are there other metrics to measure the benefit of Roth conversions?
Such a great question. And I will say, oftentimes, if people have pensions, they already have a baseline of taxable income, right? Filling up those bottom tax brackets. Those are cases where we often see the Roth conversions don't make sense. And Amy, you just did a case study on a case where Roth conversions do not make sense, right?
Yeah. And I think that is such an important part is like, I feel like sometimes Roth conversions, it could be like buzzwords. People think, oh, I'm supposed to be doing that. And for a lot of people, it does add value. But for a lot of people, it doesn't the math just doesn't make sense. I think the only thing that stands out to me in this particular question is maybe legacy planning. So even though it might not save you or your spouse taxes during your lifetime, if there's assets that you want to leave to family, Roth conversions can help leave more tax-free assets to family. One caveat I think of there is if somebody is leaving assets to charity. I've seen situations like that where I have clients that don't have a strong desire, that maybe don't have children or not a significant family to leave assets to. For them, Roth conversions really didn't make sense because they were leaving assets to charity anyways, and an IRA passes to a charity tax-free, where it doesn't pass to a child or family member tax-free.
Yeah, that's a great point. And in terms of the actual metrics, right? So it's not just taxes paid. I mean, there's two metrics we use. One is called fundedness. So, we look at the present value of a lifetime of withdrawals from accounts. And the other is what we call liquidation value at end of plan. So, basically how much after tax is left over. And when we look at Roth conversions, if we plug them into the software and both those metrics improved, we feel like, okay, clearly that Roth conversion added value, but there are times where we would plug a Roth conversion in and those metrics don't improve. And so it's not just all about taxes. Taxes are part of what ends up in a resulting either assets at end of plan. If I paid less taxes, I have more assets at the end of the plan, or what we call fundedness. If I paid less taxes, my fundedness would have improved. So those are the metrics that we are typically looking at.
Back to the HSA topic. So someone asked, do you know why HSA money can't cover the supplemental premiums? I've always wondered why.
I don't know why. Ask the government.
That's why. Yeah.
Yeah. I mean, it can cover you like on COBRA, for example, but you can't use HSAs to pay your normal health insurance. And so somehow, those private Medicare supplement plans, they said, nope, that falls under the same rule and you can't use HSA funds to cover it.
Yeah, it's confusing. Let's see here.
I do see someone mention that you can use them for Medicare Advantage plans. And that is true because that's called Medicare Part C. Yes.
Yeah. Let's see. Are you seeing that as of 2026, it's more beneficial to attempt to maintain income for ACA lower premiums versus making Roth conversions if people are retiring now and are a few years before Medicare?
Amy, you may be better suited to answer this. And the plans that I have run, and I'm not the one running plans nearly as much now. when it came down to the decision between Roth conversion or ACA, we always chose to keep income lower to qualify for the ACA premiums because that was truly like free money, right? Roth conversions, I'm paying the tax and it's growing tax-free from there. But the ACA premiums was like, I have to pay extra out of pocket or I get this for free. And every analysis I ever ran, the ACA lower premiums was the winner when it was compared to Roth conversions. Amy, anything you've seen differently?
So I actually do have a current situation that is an interesting one. And I like it because we talk a lot about math and emotion. And so in this particular situation, the math says take the ACA credit. But the client, in order to do that, they would have to spend down savings. And like you were just talking about, Dana, with that question, if someone asked about their $300,000 in money market, I have clients who have, $100,000 or so in a cash savings account. And it's just, they're new to retirement and it terrifies them to spend that money down. And so we talked about the math and, the math says, yeah, let's use some of your savings, keep your income lower. You get an extra $300 a month in healthcare tax credit. But for them, they knew that, but they thought about it and they said, you know what, we know it maybe doesn't make sense, but we feel more comfortable just keeping our savings there and we'll pay a little bit more, for our premiums because that's money that we're pulling from our investments, not our emergency fund. So that was an interesting situation, just different.
Interesting. Yeah. Yeah. And I was answering purely from the math side. When I've looked at ACAs versus Roth conversions, the ACA usually wins from the math side. But, you're talking about a situation where someone just, the cash they would have to spend down to keep their income low. They're like, oh, no, I just don't want to do that. And I can see that.
Yeah. Are I bonds a good idea for the moat?
That's a hard one, right? They could be if you can get enough in them. I think the challenge with I bonds is getting enough money into them. And I think it's, I can't remember exactly, but I know you have to own them at least 5 years to not have any kind of penalty when you withdraw. The penalty maybe after the first year is you simply withdraw 3 months worth or forfeit 3 months worth of interest, which isn't too bad. But you would have to build up an awful lot, in I bonds. And I find for a lot of households, it's just difficult. There's limits on how much you can contribute to these things. Now, when inflation was high and I've seen people open like account in the spouse's name and, if they're married and then in a trust and try to have, multiple different accounts under different names to try to get more into the I bonds. You can also have tax refunds up to a certain amount deposited into I bonds. But then from an estate planning standpoint, you have all these different account buckets. And, So yes, if I could just buy I bonds in an account, I would love them for the moat, actually, but I can't. And because of the administrative hassle of how much you can buy and how you access them, I find that they're very challenging. But if somebody wants to deal with that administrative hassle, they could be a good option.
Here's a question about Social Security. So what are your thoughts about starting Social Security early if the higher earner has significant life insurance, which would more than cover the difference in Social Security benefits between 67 and 70?
I mean, I technically I'd have to run the math. Maybe it's a paid up life insurance policy, so it's not costing anything now. I still, I would also want to understand the health situation of the spouses we're talking about. I mean, Social Security is described as like the best annuity deal in town. Like it's just a really unique benefit that goes up with inflation each year, and 15% of what you get is tax free. So if I can get that to a higher amount at age 70, it also, I told the story of the household that missed the life insurance payment, cognitive decline. People can do strange things and cancel life insurance policies or forget about them. And so from a security standpoint, I still like, having a high earner delay. But again, I would have to run the numbers. And, there's always cases where it makes such a small difference, right? Sometimes you run the numbers and you're like, it's kind of 6 to 1, half a dozen the other. And so then it's whatever you're most comfortable with.
Yeah. A question asks, what is the role of an annuity in a high value IRA for tax mitigation?
Well, I don't really see an annuity as a tax mitigation strategy if it's in an IRA. It's really a matter of securing income or cash flow. And so we look at something called a coverage ratio, how much of someone's expenses, particularly when they're out in that slow go era, how much of their expenses are covered by guaranteed income. And we like to look out in the mid 70s because that's often when cognitive decline or behavioral changes could show up. And part of having more guaranteed income is bringing more security to the future you. And so if that coverage ratio is below 50%, we might discuss, would you like more guaranteed income, or let's see how more guaranteed income would fit into your plan. And then we like to put it in the IRA because we're not changing the tax characteristics of the plan. The IRA is going to have required distributions anyway, starting in the mid 70s. And so, the annuity is just fulfilling a part of that. So there are types of IRAs or types of annuities called QLACs, qualified longevity annuity contracts, where you put a lump sum in and it doesn't start paying out till 85. And because that lump sum is now not included in your RMD balance, people will talk about that lowering your RMDs. I find that for a lot of people, that becomes then a deferred tax bomb. So now when that QLAC potentially starts paying out at 80 or 85, the distributions are much larger. And so I'm not necessarily a huge fan of that. I'm a fan of annuities when you need guaranteed income, but not necessarily as a tax mitigation strategy.
Someone asked for possible investment types to use for the moat. They said like bonds, bond funds, CDs.
It just depends on the highest yield. And so, we are big fans of agency bonds and certificates of deposit, municipal bonds for people in the higher tax rates. They're all AAA or AA rated. So you're looking at the highest quality bond. There are packages of bonds called bullet shares that can work well in smaller accounts, or they're just easier to buy than individual bonds. So if you're managing it yourself, bullet shares can make a really good option for that. And they come in different versions too. There's treasuries, there's corporates, there's munis. It really depends on how you see the role. We look at that role as like, that's not where I want to take risk. I need my moat to be there. And so I want to take the least amount of risk possible. And I'm willing to give up a little bit of yield. Some people will, go to corporate bonds or bullet shares that have packages of corporate bonds where they're getting a little more yield. We think there's a little more risk there, and that's just not where we want to take the risk.
Yeah, and I will.
Yeah, go ahead, Amy.
Sorry to interrupt. Actually, we have a new case study going live. Should go live tomorrow on our new YouTube channel. It's called "How to Build an Income Ladder," and the whole case study, 40 minutes, and we talk about what exactly to use, how to map it all out, and go through all that detail.
Awesome.
A question just came in. What do you think about the use of life insurance policies that pays dividends or as an investment tool? An agent told me I should buy a life policy for my child for future income.
A life insurance policy to me is not an investment. It is first and foremost an insurance policy that may have some investment features on it. There are some great companies out there, many of the mutual companies where, if you bought something for your child now and they kept it for their whole life and you are able to stuff it full of enough cash that it could provide tax-free income for them, one day in their future. I don't know enough about your household situation and how much money that would take and all of that, but I have seen cases where that works. It's usually not the first thing I would look at. For real high net worth households, I do think there could be some value to that. I've actually only ever come across one case where life insurance actually did deliver the tax-free income later in retirement that it was supposed to deliver. And this was someone who had put, hundreds and hundreds of thousands of dollars into these policies mid-career when they were in a very high income earning situation. And it actually worked out really well for them. But most cases I see, for some reason, people don't continue to fund it, or they don't really understand what is required for it to work that way one day. And then when you run out, what would have happened if they just would have put that money in index funds? It doesn't always look so great.
A question came in. What do we think of MIGAs, multi-year guaranteed annuities? And I'll add a comment there just because the How to Build a Bond Ladder video that's going to go live tomorrow, we talked about that as well. And Dana, I'll share my feedback, but I think of it kind of like how you answered the iBond question, that it can be a good tool. Sometimes you can squeeze a little bit higher of an interest rate out of a MIGA than you could if you're buying individual bonds or CDs. But it also adds added complexity. Like just like the iBond, you have this extra account. You can't have everything consolidated in one place like you can if you're buying individual bonds or CDs. And so they can be a great tool, but if simplicity is the primary goal, they don't necessarily fit that.
It's exactly what I would say, right? And then they often have an initial guaranteed interest rate, which when that expires, the rate can be much lower. And they also, if it's a non-qualified annuity, then it's last in, first out tax treatment. So that interest accumulates and you may not pay, any taxes on it. But then when you go to use it, you could have a larger tax event. And so you have to manage the tax impact a little more carefully.
And we did get another question about just the documents. Are they available? Those will be sent in the recording. We got some thanks, for including the Q&A and the recording. And someone I love, they said, your best webinar yet. Looking forward to the book.
Aw, that's very sweet.
Yeah. I think the only other one that we didn't get to, someone just added a comment about iBonds that, that they have been able to buy $10,000 a year because if you use your tax refund, you can get some extra. So that is.
Yeah. And if you're able to start planning, probably even before the pre-go phase to do that, I think you probably could get a good enough amount in iBonds that it could serve as part of your moat.
I appreciate all the good, the nice comments. Great webinar, terrific information. You are welcome.
Awesome. Well, thank you everybody for joining us. We really appreciate it.
Thank you for watching. We hope you gained valuable insights that will help you plan a more successful retirement. To sign up for our next free webinar, go to sensiblemoney.com or click the link below. We'd love to see you there.